My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to help you save money. My job is not just to entertain, but to educate, teach, put days like today in perspective. Call me, 1-800-743-CNBC, or tweet me at Jim Cramer. On a hideous day for the market, I mean really hideous, with the Dow plunge 543 points. Sell. S&P plummeted 1.84%. And the Nasdaq nosedived 2.60%.
The house of pain.
Some of the richest people on Wall Street desperately want the Fed to get ahead of the curve on inflation. So let me give you some plain English rather than gibberish. That means they want the Fed to wreck the economy and destroy jobs in order to push down the price of everything. They say inflation is so bad that the Fed may have to raise interest rates more rapidly than we were thinking. And when that happens, no stock is safe. We hear this drumbeat endlessly. It's like the rich inflationists want stocks to get crushed. Hey, by the way, many of them do. Many of them are short stocks or have a lot of cash on hand. They want to buy stocks much lower. Who can blame them? I just want to remind you that while the Federal Reserve will absolutely put pressure on the stock market, at the end of the day, we're investing in companies, not trading cards or Majelica pottery or pieces of eight. And it makes no sense to uniformly dismiss every company out there just because of what the Fed does. It's absurd. You think Microsoft said, hey, you know what? We want to buy that Activision Blizzard, but Jay Powell's going to wreck the economy, so let's postpone. Nope, they saw the stock was way too cheap, and they went ahead and agreed to pay $70 billion for it. Same with Unilever, smart company, monster $69 billion bid for GlaxoSmithKline's consumer business. They don't care if the European Central Bank needs to raise rates. They want to spend to make money for you. Now let's talk about a company that really got crushed. It was a major part of the Dow Jones Industrial's folly today. The company I worked at in the 80s. Let's talk about Goldman Sachs. Goldman reported today. Here's what we learned. The company capped off a year in which it had record net revenues, record net earnings, record earnings per share. They were number one in mergers and acquisitions, number one in equity, number one in equity-related offerings, highest global market net revenues in 12 years, record asset management net revenues, and record consumer and wealth management revenues. So you think, hey, that stock's got to explode higher, right? Nope. It was down almost 7%, at one point down about 10%. You think Goldman must be radioactive with that kind of decline? Something that we don't know? Well, I put my Geiger counter to it, and I found nothing. Even as everybody and his brother was saying that compensation was exploding and Goldman would be crushed by inflation. It's just not true. Goldman's not desperate to find new people willing to pay the millions. They actually paid less this year than last. I mean, go read the documents. Oh, well, maybe this is as good as it gets. That's that last great quarter scenario. Entirely, certainly possible. But Goldman's business was supposedly as good as it gets in 2016, in 2017, 2018, 2019, 2020, and 2021, earning almost $60 per share in 2021. I mean, every year was better than last. Every year that was supposed to be worse was turned to be better. No COVID asterisk, just better. We did hear some disquieting things from J.P. Morgan last week about how Jamie Dimon's talking about outspending all of his financial technology competitors. He does compete against them. Goldman, not so much. That said, the analysts are forecasting a total collapse in Goldman's earnings this year. The collective wisdom, if you can call it that, says that Goldman will earn $40 this year, fully one-third less than it did last year because of increased expenses. But when you go over the fine print, one thing's clear. Goldman Sachs is pretty much in complete control of its expenses. If some M&A partner is going to earn $10 million this year because he brought in $60 million in fees, and then those fees fall to $40 million, that partner's not guaranteed to make $10 million again. He may not even make $2 million. I know the firm. It's variable. Both ways. That's how the bonus structure works. They're in control of the bonus. Look, I know enough about trading, thank you, training ground Goldman, that when you get this kind of big selling like we saw in the stock today, the sellers aren't done. It means there's more to come. But just like the market's made up of individual stocks, the financials are made up of individual companies. And since when is Goldman's advice not given a premium? You think that's robo-advice? You think companies spend $70 billion and they want robo-advice? No. Ridiculous. Let's go deeper into today's lunacy. There's this aircraft company. There's actually one or two of them. Let's call it Boeing. We got two analyst recommendations for Boeing, in part because business is about to turn up around the world, and in part because all the terrible things that happened between 2019 and 2021 are really unlikely to happen again. Sure, Boeing could get a new CFO, and that CFO might say, hold it, we need to raise more money if we're going to expand as much as we want to and not wreck our balance sheet. But as I said in our new morning meeting video, available only to subscribers of the CNBC Investing Club. Come on, members, bring it on. I think this is the year that the 787 gets reapproval. It's the year when airlines realize they don't have enough planes, 737 MAX, when they can staff their airplanes again. It's the year of Boeing. So circling back, should Goldman Sachs really be down because Grim Reaper Powell wants everyone to make less money? Goldman's more of a get-rich-or-die-trying organization, not a get-rich-or-get-palled outfit. How about Boeing? If rates go up 0.25%, do you really think there'll be some doofus airline executive who says, I don't want enough plane. I don't need those planes. I don't need the planes. I can serve. I forget the new customers, all right? Let's just make as little money as possible. No, that's not going to happen. How about 0.5%, 4%, 1.5%? No, they're going to buy the darn planes. Do I want to be in housing if the Fed takes rates up huge? Well, less than I would be if the Fed were cutting numbers. How about furniture? Maybe not so much. Apparel. You know what? People still going to have to wear clothes. Unless the Fed says from now on, we don't want anything to be worn but denim and Hanes brand T-shirts, and everything must come from Burlington or TJX. I think the industry will be fine. Will J. Powell really maybe come down hard on Brioni, Applezzania, Bruno Cucinelli? Look out. Is the bell tolling for Porsche? How about high-performance data centers? Amazon? No, of course not. What's happening is we have to get all of the scaredy cats out of this market. Many of them are also fat cats, by the way. And then we can start thinking about individual companies and owning a stake in them. When we started our morning meeting for the investment club this morning, I wrote the word yikes on my board. Yikes. And said that yikes really isn't much of a strategy. It's just what people did. Just because so many people seem to use it as a guide doesn't mean it's right. When you pick stocks, you're owning pieces of companies, not interchangeable bits of paper. And if you regard investing as owning companies, then right now what you're seeing is Goldman Sachs, premier investment bank, selling at a little less than 6 times last year's earnings because it allegedly can't repeat the great year it just reported. Except that's what the bears say every year. And they could be wrong again. The world says these terrific results were mixed. What happens if they get less mixed? Will we pay less for a company that's less mixed? Maybe we'll pay more. You decide. The world says Goldman's not doing as well as expected, but if you look at book value growth as an apples-to-apples measure, it trumps J.P. Morgan, Morgan Stanley, Bank of America, Wells Fargo, and Citi on a 1-year, a 3-year, a 5-year, and even a 10-year basis. I mean, it absolutely crushes them. Bottom line, go ahead. Wait until Morgan Stanley disappoints tomorrow. Who knows? PNC, I don't know. How about the Bailey building alone? Wait till that collapses. Or you can take my approach and consider that Goldman Sachs is a place where it's almost impossible to get a job, a place that offers terrific proprietary advice that corporations have always paid a premium for decades and decades. And right now, you can get the stock for $70 less than where it was 2.5 months ago. There. I think it's a steal. Mitch in New York. Mitch.
Hi, Jim Cramer. Thank you for taking my call.
My pleasure.
Okay. About a week and a half ago, Linde was at 352.18, then dropped to 336.28. Today, at 321.16, down 7.58. I heard that with improving industrial production worldwide, Linde is set to gain from the recovering industrial gas demand. Do you see the share price increasing and maybe a stock split in the future?
Don't know about the stock split, but Jeff Marks and I discussed this very issue for the investing club this morning. I said, when do we buy this, Linde? It's down again. It's down again and down again. He reminded me, listen, we might be able to get it cheaper. We got it under 300. But I agree with your sentiments, Mitch. I think that Linde is right. I think its company's going to do well. I think you have to start picking away at the stock down 7. Hayden in Oklahoma. Hayden.
Hey, Jim. Hope you're doing well. This is Hayden from Oklahoma. I've been invested in AMC since January of last year. I know you aren't the biggest fan of the stock.
No.
However, I'm curious to know why you would want to stay away from the stock on the precipice of a short squeeze, absurd short interest, over 90% owned by retail. Look, quite frankly, the current price does not matter when there's still billions of naked shorts that must be covered. And with the overall market, it's sort of a goalie. You almost have to wonder if there's major liquidity issues within the hedge funds that are short.
Well, I mean, look, it could be. I think the company should have offered even more stock. I think, look, you got one of these periods where if anything has a lot of debt, that stock goes down. And that's the way to look at it. And it doesn't seem to matter whether there's a short squeeze or not. Adam Aaron's done a great job keeping it afloat, though. Let's go to Charles in Virginia. Charles.
Hey, how you doing, Jim Cramer? How are you, buddy?
I'm having a good day. Thanks for the question. How about you?
I'm doing wonderful now. I'm a great fan. I just want to say I'm so grateful for you having me on. I'm excited. Thank you very much.
Excellent.
Yeah, Mr. Cramer, I was wondering, I remember that you had kind of featured Unity software on your show maybe sometime last year, and I kind of built up a position, and it kind of had a run last year. And since then, it's kind of fallen back. I haven't really seen any news on it. I was wondering, is this a keeper or should I sweep her?
Well, I mean, the reason why it's going down is because it's not making money. The reason why it's a great investment is because John Riccitiello has a multi-year strategy and has got one of the best metaverse situations going. Do I think that the stock should be bought here at $32 billion when it's losing money? I would buy a little, and I'd buy it staged. Say buy 112, then maybe 106, then maybe 98. You buy a little bit. They wanted to buy 200 shares, you buy 50 tomorrow, and you buy 50 on the way down. That's how we do it with the investing club. I can't tell you otherwise. Tons of lunacy in the market today. We have to get all the scaredy cats and maybe some of the fat cats out of the stock market. And then we can start thinking about individual companies and owning a stake in them. Because, by the way, that's what we do. I think a stock like Goldman Sachs is getting to be a steal. Not yet. They're big sellers, but you get my point. On Mad Money tonight, oil soared to its highest level in 7 years. Worrisome. What could the remainder of the year hold for the hot commodity? I'm talking to RBN Energy's Rusty Brazil. And Airbnb's founder and CEO now said he's going to start living on Airbnb by staying in a different town or city every few weeks. Should investors follow his lead? Maybe even move into the stock. I'm going to give you my take. And a knack for SPACs. Sports Entertainment Acquisition Corp is expected to close its deal with sports betting group Supergroup in the coming weeks. I don't like SPACs, but how about this one? What are the odds of a favorable return? I'm talking to the company's top brass. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com. Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.